Hello, and welcome back to the channel. I'm Algabot, and today we're taking a close, educational look at an expert advisor for MetaTrader 5 called Gap Fill Fade Reversal. This is a pure price action strategy, which means it uses no traditional indicators at all. There are no moving averages, no oscillators, and no volatility bands. Instead, it studies the empty space, or gap, that appears when one bar opens far away from where the previous bar closed. By the end of this video, you'll understand how the strategy detects that gap, how it confirms a reversal, and how it manages its stop loss and take profit. Let's get started. Let's begin with the big picture. Gap Fill Fade Reversal is a mean reversion strategy. The core idea is something many traders observe on the charts. When price suddenly jumps away from where it was trading, leaving a visible gap, it very often drifts back to fill that empty space before doing anything else. This strategy aims to take part in that snapback move. Rather than chasing the jump in the direction it traveled, the strategy fades it, meaning it leans the other way and targets the level price came from. Because it relies only on the open, high, low, and close of recent bars, it works on any symbol and any time frame you choose to attach it to. You'll commonly see gaps on instruments that react sharply to news or to session opens, but the logic itself is general. It simply measures how far one bar opened from the previous bar's close and compares that distance to recent volatility. The strategy is designed for traders who appreciate a clean, rules-based approach without a screen full of indicators. Every decision comes from price structure alone. It also includes a confirmation requirement, so it doesn't enter the moment a gap appears. It waits for the gap bar itself to show a rejection, closing back against the direction it jumped, which suggests the initial impulse is already fading. Now, an important note before we go further. This video is educational information only. It is not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses are a normal part of any strategy. No approach signals correctly every time, and this one is no exception. Our goal here is simply to understand how the logic is built and why each rule exists, so you can study it thoughtfully. With that framing in mind, let's open up the mechanics and see exactly how the strategy decides when to act. Let's walk through the logic step by step. The strategy acts only once per completed bar, so it isn't reacting to every tick. When a fresh bar opens, it looks back at the two bars that just finished. We'll call them the prior bar and the gap bar. First, the strategy needs a sense of scale. It measures the average range, high minus low, across a window of recent bars set by the RangeLookback parameter. This average becomes a neutral, price action yardstick for how much this market typically moves. There's no named indicator here, just a simple average of recent bar sizes. Next, it calculates a threshold by multiplying that average range by the GapMultiple parameter. This threshold defines what counts as a meaningful gap. A small gap multiple makes the strategy sensitive to modest gaps, while a larger value insists on bigger, more dramatic jumps. Then it measures the actual gap, which is the gap bar's open minus the prior bar's close. If the gap bar opened well below the prior close, beyond the threshold, that's a gap down. If it opened well above, beyond the threshold, that's a gap up. But a gap alone is not enough. The strategy also requires a rejection close. For a gap down, the gap bar must close bullish, finishing higher than it opened, which signals buyers are already pushing back. The strategy then prepares to fade long, expecting price to rise and fill the gap. For a gap up, the gap bar must close bearish, finishing lower than it opened, and the strategy prepares to fade short, expecting a drop to fill the gap. When both conditions line up, the strategy opens a market order at the new bar. The take profit is placed back toward the pre-gap close, scaled by the TargetFraction parameter, since partial fills tend to be more reliable than the very last tick of a gap. The stop loss is placed just beyond the gap bar's far extreme, buffered by the stop buffer multiplied by the average range. Finally, the strategy runs a sanity check, confirming the stop loss and take profit sit on the correct sides of the entry. It also holds only one position at a time, letting the stop and target resolve before considering the next setup. Let's read through the code as it appears in MetaTrader. At the top are the input parameters you can adjust in the strategy settings. Lot sets the trade size. GapMultiple controls how large a gap must be before it counts, measured against recent volatility, so raising it demands bigger jumps. RangeLookback decides how many bars are averaged to build that volatility yardstick. TargetFraction controls how far back toward the pre-gap close the take-profit reaches, where 1 means the full fill and a smaller value books a partial fill. Stop buffer sets how much breathing room the stop loss gets beyond the gap bar's extreme. Now to the signal logic. The strategy first computes the threshold by multiplying GapMultiple by the average range. It then measures the gap as the gap bars open minus the prior bar's close. A positive number means a gap up, and a negative number means a gap down. The two Boolean conditions combine size and direction of close. Gap down is true when the gap is at or below the negative threshold and the gap bar closed bullish. Gap up is true when the gap is at or above the threshold and the gap bar closed bearish. That second part, the rejection close, is the confirmation that price is already pushing back. Inside the gap down branch, the strategy measures the size of the empty space, reads the current ask price for entry, and sets the take profit toward the pre-gap close, scaled by TargetFraction. The stop loss sits below the gap bar's low, padded by the buffer. The line checking take profit and stop loss against entry is a safety gate, ensuring the order geometry makes sense before the strategy sends it. Let's walk through this illustration to see both sides of the strategy. The blue dashed line marks the gap fill target, which is the pre-gap, close near 1.0850. Think of it as a magnet that price tends to return to. Watch the early bars settle quietly around that level. Then the fifth candle opens with a sharp gap down, while below the previous close, leaving an obvious empty space beneath the line. Crucially, that same gap bar closes bullish, finishing higher than it opened. That rejection is the confirmation the strategy waits for. On the next bar, the buy signal appears as the strategy fades the gap down, expecting price to rise and fill the empty space. Notice the stop loss would sit just below the gap bar's low, while the take profit aims up toward the dash target. Over the following candles, price climbs steadily and reaches that gap fill level, where the long trade closes at take profit. Now the chart resets to calm near the line again, and we see the opposite case. A candle opens with a sharp gap up, jumping well above the previous close. This time the gap bar closes bearish, finishing lower than it opened, which is the rejection the strategy needs for a short setup. On the next bar, the sell signal appears as the strategy fades the gap up, expecting price to fall back and fill the space above. The stop loss would rest just above the gap bar's high, and the take profit aims down toward the dash target. Price then eases lower over the next candles and reaches the gap fill level, closing the short trade at take profit. Remember, this is a clean, illustrative example. In live markets, not every gap fills, and price can move against the position to the stop loss. This visual is simply here to make the logic clear for educational purposes only. And that brings us to the end of our look at gap fill fade reversal. We covered how this pure price action strategy measures recent volatility, how it defines a meaningful gap, and how it waits for a rejection close before fading the move back toward the pre-gap level. We also walked through the input parameters, the core signal code, and a chart showing both a long and a short example. Remember that everything here is educational information only and not financial advice. Trading involves real risk, and losses are part of the process. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with strategies you'd like us to explore next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.